Hey, it's Christy, and I want to share a couple of tips if you are in the market of buying a home right now and you find yourself making offer after offer and not getting them accepted, or you're constantly getting beat out by cash. If you're financing your purchase, kind of puts you in a different place and it's difficult right now. So I want to give a couple of tips of what's working for some of our buyers, and hopefully this will help you too. So whether you're a realtor or you're a buyer in the market, I hope these tips help. So tip number one, lean hard on your loan officer partner. So whether you're the realtor submitting the offer or you're the buyer, once that offer is submitted, make sure your loan officer calls the listing agent and brags on you. Now, as a loan officer, we can only say certain things, so we can't expose too much information about you personally. We can talk about the strength of the deal, that you already have that money in the bank, you don't have to rely on a gift or pulling out of your 401k or something along those lines. So we can talk in some detail, but more importantly than that, that listing agent representing the seller really wants to have that fear of having a financed offer accepted. So if your loan officer calls and not only brags on you, but also says, you're going to hear from me all the time with updates. Personally, I do weekly updates, and then I also update immediately upon milestones. So once you get that approval, once we have the appraisal, I call or email that listing agent, and that's what's really important. They want to know that they're going to be communicated with open communication and constant updates, and they also want to know that it is a secure and solid deal. Unfortunately, with so many of these online and call center type of lenders out there, there's a lot of loans that don't make it to closing. The last statistic I had read was somewhere around 50% of mortgage loan applications that start don't actually get to the closing table. So that's a crazy statistic if you really think about it. So we've got to do a really great job of taking that fear out of the listing agent accepting your offer. So we want to make them feel really confident about working with us. If you're in a position, consider not having an appraisal contingency. This is where people are getting tripped up. You could be the highest offer by $50,000, but if you're getting financing and that home doesn't appraise, now you got to come back down and have a conversation around that appraised value, not the contract price, because a loan is structured off of appraised value or contract price, whichever is less. So I'll give you a couple of strategies that I see that are working, and if this works for you, consider taking this on. I recently had a buyer get her offer accepted because she said she was willing to pay $12,000 over the appraised value. But here's what's really important for you to understand. You cannot roll that shortage into your loan, not directly. So let's say you have 20% down, you're no longer at an 80% loan to value. If you want to roll it into the loan, maybe now you're at an 85% loan to value, which might add mortgage insurance to the equation. However, that would keep you from having extra money out of your pocket. It would just keep you at that same amount that you wanted, but the percentage has changed because now we're basing it off of the appraised value, which is lower than your contract price. If that's not something that you want to do and you have extra money that you're willing to put into it, then just know that it would be your down payment, your closing costs, if you're the one responsible for your closing costs, plus that, for this example, $12,000 shortage. So here's an example. She wrote her offer for $280,000 and we're thinking it might appraise somewhere around $260,000, $265,000. She's selling her current home, so she's going to have that extra money available, and we set it up with 5% down payment. Even though she has more than 5% to put down, this gives us a little strategy where if it doesn't appraise, we can finance at 5% down her closing costs, and then at up to $12,000 shortage in the appraisal amount as far as her cash to close at closing day. Or if it winds up appraising or getting really close to that contract price, then we're going to just structure it where she's putting 10% down. You're welcome to put down more than what you want to on the contract, but you can't say necessarily that you're putting down 10% and then come in with 5% unless you restructure that loan and let the seller know what you're doing because of that appraisal shortage. And as long as everybody's on the same page and fully disclosed, then it should be smooth sailing moving forward. If you are going to use this strategy, my recommendation is to send proof of funds of that cash money that you have in the bank to prove to them that you have the ability to pay that shortage or that difference. And then that will be a difference maker with the seller wanting to accept your offer versus somebody else's, because you're guaranteeing them some, dollar amount above what that appraised value is, because you don't really have control over the appraisal. Remember that the appraisal is based on history. It's homes that have sold in the local area about 1 mile out from that property and 6 months back. So if history is a lower price point because now we have this shortage in our inventory, right? There's more buyers than there are sellers. So people are willing to pay more for this item. It's simple supply and demand in basic economics. But that doesn't mean that it's actually worth something on paper. Even though you're willing to pay for it, you're gonna maybe have to come out of pocket for that difference. But if you're willing to pay $280 for a home and it appraises out at $265, you're still winning because you were willing to pay $280 for it. Where it's difficult is if you are a first-time home buyer or have very limited down payment where you only have maybe 3% down or 5% down, that doesn't give you a lot of wiggle room. So if you don't have that extra cash for that appraisal difference, that puts you in a really tough place, so you won't be able to use that strategy. Consider making your escrow deposit a non-refundable deposit. Now, I'm in the state of Florida. I know every state is a little bit different, so I don't know how other states work. I'm only licensed in Florida, so I can tell you how it works here. Typically, if the contract falls through because of inspections, maybe it doesn't appraise out if you have that appraisal contingency, or if for some reason you wind up not being able to be approved for your loan and you get a decline letter, you get your escrow monies back as long as it fits inside of those contingency timelines. In other words, the deadlines that are written into the contract by your realtor. As long as it fits inside of that, you should get your escrow monies back. So that's like your good faith monies that you put in advance of closing day, letting that seller know, look, I'm so serious about this offer, I am putting some money on the line. And you only put it forward once you go into contract, at least in the state of Florida. So what if you said, look, it's non-refundable? Or what if you had said, hey, I'll put a second deposit down for X dollars once we have our loan approval and the appraisal in, so you know I'm totally committed. So maybe your first escrow deposit is $2,000 and you're willing to put another $5,000 on the line, so you show them, hey, I'm moving forward, I'm totally committed, we're gonna close, this is my commitment to you. That's one more way to stand out to the seller when they are reviewing their offers, especially if you've got 10 offers getting submitted to the seller. I'm seeing some people offer a really short window on the inspection period and also on the appraisal and approval scenario. So a lot of times you have somewhere between 10 and 15 days for inspections, maybe considering lowering that down to 6 or 7 days, as long as you talk to your home inspector and you know that they can get out there in that kind of time frame. That could be a benefit for you. Also, if you're working with a lender that can move super quick and make sure your loan officer blesses this, maybe you can have a very short contingency or window on that approval financing contingency. If that's the case, you might be able to stand out a little bit as well, because they're not having to wait, say, 2 or 3 weeks for that financing contingency window to close. You might be able to tighten that up in like the first 7 or 10 days, and then everybody sleeps well knowing you are fully approved by the underwriter. And this is my very, very best tip, well, behind the appraisal tip, but I love this, and this is happening to a lot of my buyers right now. They're actually offering a lease back to the seller. So think about it this way. Let's say the seller is getting ready to buy their next home, right? And they need to get it under contract with you, but they don't necessarily want to have their whole home packed in a truck, sitting out in the parking lot at the title office or the law office the day of closing, and have to, be out and in the same day. Maybe consider offering to the seller, and it's really important that you as a realtor or your realtor obtain some information, as much information as they can about the seller. What are their needs? If you can help match those needs for the seller, there's a really good chance they'll accept your offer. So let me give an example. Let's say they're building a home and they want to sell their home, but they don't necessarily need to be out for, say, 3 months because their new construction home build isn't going to be ready for 3 months. Allow them to close and rent back from you, or say, great, we'll take our time going through the process and we'll close it in 3 months from right now. Whenever your home is ready, that can be our closing date. So if you have 3, 4, 5 months left on your lease, or if you're living with family, or if you're month to month, this is a really ideal way to show flexibility to the seller so that they are encouraged to accept your offer versus somebody else's, because you have that flexibility. The other thing is if they need to close on the sale of their home, but not have a contingency for their next purchase, you'll want to close quickly with the purchase of the home that you're trying to buy, and then allow them to lease it back. So in other words, they're not moving out of that house right away. And all loan programs will allow this to happen as long as you are able to move in within 60 days of closing. So that's the magic number. So from the day of closing to when you are able to move in, it cannot exceed 60 days. And you're going to have to sign something in your mortgage loan paperwork the day of closing that says that. So make sure that the lease doesn't go further than 60 days from date of closing, because an underwriter won't be able to bless it that way. But think about this. Now the seller's closed, so it's not contingent on the sale of their home, and then they can kind of take their time finding their next home and then get closed on that, move out, and then in the meantime, you're making rent off of them. So you would agree on a separate agreement from the sales contract how much they will pay you. And honestly, it should be above fair market rent, because you're doing them this favor, but they're doing you the favor by accepting your offer because you're the one that's being flexible to them. So everybody wins if you think about it this way. So if you're in a time position to be able to do this, maybe make that part of your offer or part of that initial conversation, and it will really take a lot of pressure off of the sellers. I have bought and sold in the same day and didn't have a lease back, and let me tell you, it is totally stressful because you need a mattress to sleep on the night before if you don't have a hotel or a friend's couch to live on. So you're finishing loading up the truck that morning, you're getting over to the title company to sign the paperwork. It is a disaster. It's really stressful. And then after you sit there and sign papers for an hour, hour and a half, kind of anticlimactic too, by the way, now you're going to your new home to unload a truck. That is exhausting. So if you can make that happen for them, it's a really great strategy to separate yourself from everybody else. So I also wanted to throw in a little bonus to this video. I want to talk about some strategies if you're selling your home and buying your next home kind of at the same time as well, about some strategies to help better position you as a buyer. So if you're a first-time home buyer, this really won't necessarily apply to you, but if you are selling and buying, listen in, because this can get really good, really juicy for you. You ready? Let's do this. There is a feature on conventional mortgages. So if you have an FHA, VA, USDA, or jumbo loan, this may not be part of it, but there is a feature inside of a conventional mortgage that's called a recast feature. So stay with me because it's a little bit unusual. So let's say you have in your pocket right now 5% that you can put down on your next purchase without having to currently sell your home. If you have that available from you, whether you have a home equity line on your current home that you can tap into, you have a 401k you can borrow against, or you have this money in savings, here's what you do. You can put an offer in on your next home with 5% down. And then if you struggle with carrying the costs of the new home you're going to buy and your current home that you already own, what you can do is you can pay for an appraisal on your current home, not a full appraisal, it's just called a rent schedule, and it's going to tell you what fair market rent is on your current home. Now, what you're going to do is you're going to be able to use 75% of that fair market rent to help offset your current home carrying costs, so principal, interest, taxes, insurance, and the HOA if you have an HOA. So let's say your current housing cost is $1,400, but you can actually rent out your home per this rent schedule for $2,000 a month. We can use 75% or $1,500. So we can use $1,500, but your housing payment over here is only $1,400. So you're actually net positive $100. So we're suggesting that you're going to turn your current home into a rental property. You're really not going to. You're just going to sell it later, okay? And you're going to put 5% down on your new purchase. Now this is going to have you where you have mortgage insurance. But listen, this is all temporary. Get that home into contract, and then you can get your home listed on the market. So let's say you're going to sell your home a month or 2 months after you buy your next home. Then what you're going to do is when you sell your home and you close on it and you get all of that equity out of it, you're going to call your new loan servicer. So the new loan on the new home you just bought, you're going to call them and you're going to say, I'd like to recast my mortgage, and they're going to give you specific information on how to get them that money, so that way it reduces not only the principal, okay, so you do have a principal reduction, just like if you were to just give them all that money anyway, But by going through this strategy, they're going to recast or reset your principal and interest payment based on this new lower loan amount. And if you've got that 20% equity now, based off of that purchase price, they're gonna eliminate that mortgage insurance. So it totally goes away, so you don't have to have it for any set amount of time. It's an amazing strategy to do this, where you can buy your next home without making it contingent upon the sale of your current home. Really, really extraordinary way of going about it. So the second bonus I want to give to you is called delayed financing. So let's say you sold your home up north and you've moved down to Florida and you're buying your next home, but you want to pay cash for it so that you wind up looking different from any of those financed buyers, so you have a better chance of getting your offer accepted. But you don't necessarily want to have all of your cash go into the house. You can pay cash money for that house, and then as long as it's within a very short window, typically 3 to 6 months from the time that you've closed on that home, now we can do what's called delayed financing. You explain to the underwriter that you paid cash money for this house. You can actually get a big chunk of that money back, up to 80%, you guys. I just wanted to be the one to share this strategy with you, to give you one more tool in your toolbox and help separate you from everybody else. If you haven't already, please subscribe to my channel. I'd love to be a resource for you. And good luck out there.